Hey everybody, the bull is back. Man, he's heavy. Today we're going to talk about another strategy, option spread trading. I get tons and tons of questions about options, how to do it properly. There's so much written about it. Larry McMillan had 600 pages. People still can't do it properly. So we're going to take a look at option spread trading in particular because those seem to be the questions that I get the most. Hi everybody, my name is Frank Bunn and I've been teaching people how to get consistent trading anything that's chartable since, well, it's been a long time. All right, by the end of this video, you're going to understand what an option spread is if you don't already or have no empirical knowledge of it. You're going to understand why, if you know how to trade and how to trade direction, it's just generally not a great idea. You're also going to know why it's talked about so much, and you're going to know what to do to actually get consistent and make money and consistently profit from what you do want to trade. Okay, so this is going to do a lot of good for a lot of people. All right, so let's jump right in and take a look at option spreading. And what option spreading is it's part of a family of strategies called delta neutral. All right, and that's really a fancy name for it doesn't matter if the market goes up or down, you can profit from it. All right, that should be the first indicator that this is shaky at best. There's risk in all things. And there is no mathematically sound or even possible truly delta neutral strategy, which means there's always risk in the options trade. And I really want you to understand that. There is no delta neutral strategy as long as the underlying component or what the option is based on is moving around. People might tell you that. That's the bullshit component of it. Okay, so now that we understand, okay, it's delta neutral, what people are trying to do is they disavow market movement in lieu of, hey, I can put these positions on and I can profit. Well, as a result, because of the type of spread, we're gonna look at bull, we'll look at bear put spreads and bull call spreads. So let's just take a look at bull put spreads to begin. Okay, so that's gonna be the easiest thing. So the way you set up this spread is we're going to sell time. We're going to sell the option first. So we're talking about a put spread here. Okay. We're going to use that as our primary example. So what the trader does is price is at X right now in this band. All right. So price is up here. Okay. So the trader thinks that the market's going to move higher. That's important here. Okay. So what does he do? Goes down to a certain price level below that because he thinks price is going to stay above that. And he sells a put, all right? He's going to get a profit, the premium that he sells that for, he's going to be able to pocket. Sounds like a great idea. Here's the problem though. If price were to fall below that and could theoretically fall indefinitely, this means that this put has unlimited, theoretically, unlimited risk the whole way down to where the stock is zero at the bottom of the game. Okay, this is a problem. So what does the spread do to protect that? Well, the spread goes down to a lower price, and here the trader is going to buy a put. All right? Okay, now, he's going to earn, we're going to say for sake of argument, he's going to earn, so he's going to be in the green and the red here, in the black. Let's say he's going to earn $100 for selling that spread. Okay, he's got to buy the put, which means he's got to come out of pocket. So down here's the issue. So now he has to spend $45 down here to basically cover his ass. Now, here's the problem. This makes the risk window in here. This is called the risk window. This is what he risks. The amount of loss between his put and his buy. As if he comes up closer to the put that he sells, he doesn't make any profit. So right now he's going to pocket $55. Okay, for basically doing nothing, selling time so that the price goes up. He pockets his $50. The put expires worthless. This one expires worthless. He keeps the difference, and yeah, everybody's happy and goes away and orders a Porsche. Okay, here's the problem. All right, so $55 is his spread. If he has 10 of each of these, 10 times 100 is going to be equal to $1,000. All right, 1,000. Okay, 10 on the lower leg is 450. Okay, you can see immediately that his risk window, and this could be more or less. This is just a theoretical argument, but you can see that his risk, depending on how this shakes out, because he has to spend this. The problem is the delta in between here. Okay, so what that means is the put that he sells, okay, is going to appreciate a whole lot faster. Now he's short that, remember, so when it's falling, when the price falls, he's out of the money, he's losing. Okay, so he has to short that. So that's going to increase in delta. This put is going to increase in delta like this. All right. The put that he buys is going to increase in delta something more like this. All right. This one is going to lose exponentially faster than this gains. All right. So in theory, you generally are going to risk 5 to 10 times what you actually make. All right. So you're going to make 55, but you're risking at least 300 if this doesn't work out. Now, if that sounds like a really bad idea, it really is. So what are we looking at here then? Like, what is the problem? Okay, well, if we take a look at the spread then, the bull put spread then has what's called an inverted risk skew. Okay, it's inverted, meaning it's going to lose time after time, given 10, 20, 30 trades, whatever. When it loses much more than it gains. So as you know, what I teach traders to play a risk game where they only risk 1 and they get somewhere between 3 to 10 in profit. That's a viable risk game. Here a guy can get consistent. This is picking up pennies in front of a steamroller. All right, so now you understand what the spreading does. Anytime that you have a spread, any option spread, that first begins with a short leg at one striking price and a long leg further out of the money, it's going to have an inverted skew, which means any option spread has an inverted risk skew. This is a problem. So what do you need to do to make it work? Well, I'll tell you, you need to know which way the wind is blowing. That means you need to understand direction. You need to know what the price is likely to do in the near future. Okay? So if you do have this knowledge and you can take low risk trades, you can make spreads work. But why do that if you could profit in full from the total aggregate price moving up? Now, when I mastered my direction game after I was taught to trade in the 90s, what I did is I didn't do any kind of spreading. I traded options I traded long calls and puts. Okay? Meaning I just bought the call. Now, what did I do? I controlled my risk. We'll go over this in another video. This is really like way too much for one video. But I would go longer call put with no spread on it, with no short leg. So as this moved up, I had theoretically unlimited profit. And because I was playing the proper risk game, okay, of like 5 to 10 and one risk, I could keep a big chunk of the long call or long put premium. I didn't lose all the premium because I traded them the right way, and I can show you how to do that. Okay, so now you understand. Okay, so if you do know how to trade and you know how to sniff out direction, which is what I teach students to do, you don't need to trade options spreads. All right, so what's going on here? I mean, what's the issue? Why is this talked about? Well, one main reason. It is the option. Whoops. I'm just going to spell this out. The options broker. Who does all the talking about how easy it is to trade options? Thinkorswim, Charles Schwab, whatever. They're selling these. So they're on the supply side, which means they get commissions. And yeah, it's the realm of commission-free trading, but most platforms still charge option commissions. So what happens with this spread? They've got a long leg and a short leg. They get to charge double the commission. Okay? Plus, they sell the contracts at CBOE or whatever. They get order flow compensation for that. Man, you want to make a ton of money, you become an options broker and sell these picks and shovels to the gold diggers, man, because that's exactly what they're doing. And so you're going to get a lot of information on the internet, in ads, wherever, coming generally from broker dealers, just like they do in all the other rip-off markets like Forex and whatever else, because they're making the money. So you gotta be careful about what you're told. The other thing that you're told all the time, and I even got some articles from an old student, so that you're told that these positions, once they move against you, can be repaired. I've even saw one Udemy instructor tell people that he had a 100% win rate, just flat out dishonesty. They can be rolled over, and you can try to initiate another position or adjust the spread, make what's called an adjustment, so that you partially recoup the loss, but they cannot be. There is no such thing as absence of loss in this game, just like there's no such thing as pure delta neutral position. So that's another thing people are told, which attracts them to this. And the third reason, the reason that you should not be doing this, is people feel they don't have a choice because they are undercapitalized. If you do not have enough money and you feel that options are a way that you can enter the game cheaply, that is never an excuse. You're better off to take the time, learn how to trade for a point in your life where you're greater capitalized. I work with a lot of young traders, guys or women and men in their 20s, early 30s, that don't have a lot of capitalization. It's easy to see at that age, that time is short, but in their 40s, even 50s, they can make one run and generate wealth. And so you can learn how to do this for a time in your life. It's a very, very valuable skill when you are better capitalized. Okay, so those are the reasons why not to do it. Okay, so what do we know? If you're going to do it, master direction, and mastering direction is knowing how to trade so that you can make the best use of the option leverage. Direction, knowing which way the wind blowing. That is the key. Other than that, spreading, don't even bother. All right, that does it. Now you understand exactly what a spread is, why you really don't need it, and why you just need to learn how to trade, reduce risk, and get theoretically unlimited profit as opposed to very small amounts of profit with massive risk, which is why these guys blow up. All right. If you want to learn more about how to do this, we're going to talk in another video about how to select low risk options, because it's very easy to do. Most people don't do it properly. They'll do it as a surrogate for stocks. I can teach you that. And then in a link below this, you'll see that I have a webinar where you can learn exactly what the steps are that you need to take in order to crack the game, get consistent, learn how to do this, how to reduce risk, and build significant wealth. All right, thanks everybody. We will see you next time.